Gold is not supposed to do this. Not like this. This isn't a slow climb, this isn't a hedge quietly doing its job. This is gold sprinting uphill like it just heard something terrifying behind it. And that's the part that should make you uncomfortable. Because gold doesn't usually move first, gold moves when confidence breaks. When systems creak, when people with access to better information than you quietly change their behavior. And right now, gold is behaving like it knows something the rest of the market hasn't fully priced in yet. For decades, gold was boring. Respectable. Predictable. Over the last 40 years, it averaged roughly 6 to 7% per year. Not exciting. Not dramatic. The financial equivalent of a reliable sedan. But over the last 5 years that changed. Gold has been compounding closer to 20% annually. That's not normal. That's not historical. That's not what a safe, boring asset is supposed to do in a healthy financial system. Which means one of two things is true. Either markets are mispricing gold in a massive way, or the world is changing faster than people are willing to admit. And here where it gets strange. Ask 10 traders why gold is surging and you'll get 10 different answers. Inflation, geopolitics, debt, central banks, currency debasement, fear, greed. Everyone has a theory, almost no one has a complete explanation. Because the real story isn't obvious on the surface. So let's slow this down, strip away the noise, and talk about what's actually happening. Because once you see it, you can't unsee it. The most common explanation you'll hear is inflation. And on the surface, that makes sense. Prices went up. Purchasing power went down. Gold is supposed to protect against that. But here's the problem. If inflation alone were driving gold, this move should have happened years ago. Back in 2021, inflation was exploding. CPI prints were coming in hot. Money supply had just ballooned. Real rates were deeply negative. That was the perfect environment for gold. And yet it barely moved. Gold stayed flat. It lagged. It was disappointing. Only recently did it wake up. That timing matters. Because it tells us inflation is part of the backdrop, not the trigger. So if it's not just inflation, what changed? The answer isn't loud. It's not dramatic. It's not trending on social media. It's quiet. It's institutional. And it's happening behind closed doors. For nearly 80 years, the US dollar has been the backbone of the global financial system. It's the currency central banks trust. The currency trade is settled in. The currency reserves are built around. Not because it's perfect, but because it's stable, liquid, and backed by the world's largest economy and military. That system worked extraordinarily well. But systems don't break overnight. They erode. And erosion looks boring while it's happening. What we're seeing right now isn't central banks dumping the dollar. That would be obvious. And dangerous. Instead, they're doing something much more careful. They're diversifying. 20 years ago, over 70% of global foreign exchange reserves were held in US dollars. Today, that number is closer to 58%. That 12-point drop doesn't sound dramatic until you remember we're talking about trillions of dollars. This isn't panic. This is hesitation. It's the central banks quietly saying, we still trust the dollar, but not enough to bet everything on it. And here's the key detail most people miss. They're not rotating into euros. They're not piling into yen. They're not chasing another fiat currency. They're buying gold. Aggressively. Over the last 3 years, central banks have purchased more than 1,000 tons of gold annually. That's more than double the average of the previous decade. In fact, the most recent year marked the highest central bank gold buying on record. This isn't retail fear. This isn't speculative hype. This is institutional positioning. And institutions don't move like this unless something fundamental is shifting. Gold in this context isn't about return. It's about optionality. Gold doesn't default. It doesn't get sanctioned. It doesn't rely on another country's fiscal discipline. It just exists. And when trust becomes conditional instead of absolute, gold becomes useful again. This doesn't mean the dollar is collapsing. That narrative is lazy. The dollar is still dominant, still deeply embedded, still the cleanest shirt in a dirty laundry pile. But dominance doesn't have to disappear to matter less. Even a small change in trust at the margins can reshape flows. And that's what gold is signaling. Not collapse. Now here, where the story gets uncomfortable. Because if this were purely a fear trade, we'd expect stocks to be falling. But they're not. Stocks are near all-time highs. Risk assets are elevated. AI valuations are pricing in a future where productivity explodes and profits follow. And at the exact same time, gold is also at all-time highs. That's not how markets usually work. Historically, assets pick sides. Either optimism wins and capital flows into growth, or fear wins and capital flows into safety. But right now, both are winning. And that tells us something important. Markets aren't confident. They're conflicted. Stocks are pricing a future of innovation and expansion. Gold is pricing a future of instability and hedging. Bonds, they're stuck in the middle, signaling uncertainty about inflation, growth, and policy. Every major asset class is telling a different story, which creates a strange environment where reasonable people can look at the same data and walk away with completely opposite conclusions. And that dissonance matters. Because markets don't behave like this when the path forward is clear. They behave like this when participants don't agree on what risk actually looks like anymore. This gold rally isn't about fear today. It's about doubt tomorrow. Central banks aren't reacting to a crisis that's already here. They're hedging a future they can't fully model. Rising debt levels, geopolitical fragmentation, weaponized finance, long-term fiscal credibility. None of these issues explode in a single moment. They accumulate. And gold doesn't care about narratives. It reacts to incentives. Right now, the incentive to hold a neutral, non-political, non-liability asset is rising. Quietly, steadily. Which brings us to the uncomfortable question. If the biggest, slowest moving players in the global system are repositioning, not urgently, not loudly, but deliberately, what do they see that markets haven't fully reconciled yet? Because gold doesn't scream. It whispers. And right now, it's whispering that certainty is fading. Not collapsing. Not disappearing. But thinning. And when certainty thins, hedges matter again. That doesn't mean gold will keep going up forever. It doesn't mean stocks are doomed. It doesn't mean a crisis is imminent. It means the world is entering a phase where confidence is no longer taken for granted. Where diversification isn't theoretical. Where risk isn't obvious until it already exists. And that's why this move matters. Not because gold is shiny. Not because it's making headlines. But because of who is buying it and why. Because when the quiet money moves first, it's usually not chasing returns. It's preparing for change. And the only real question left is this. What happens when everyone else finally notices?